And welcome to the Nerdy Agent Podcast. I'm your host, Luke Pedersen, alongside my brothers and fellow nerds, Josh and AJ. Today, we are going to discuss the last Fed meeting, what it means, how the market reacted, and what it means heading into 2024 as well, what you can talk to your clients about, what you should expect from the market. But first, the controversial Would You Rather of the week that we are going to axe next week.
What is the controversial?
Hold on, Luke.
I want to talk about the move Josh just made to drink that coffee. That was so impressive. He
Isn't it
didn't know if he wanted to go arm over or under. So he just kind of like scrolled his body around it.
AJ's using this to show off his biceps.
We don't have much time because AJ has to leave to get to another
content creation
event. So the last Would You Rather of the week. Are you ready? Would you rather eat a traditional Thanksgiving meal and fit within the holiday spirit, or pivot and eat something different that you get to pick out yourself?
Josh definitely wrote this because he put like a very clickbaity word for real estate, which is pivot.
Make holiday spirit.
I mean, like Thanksgiving is like a traditional meal. You sit on Thanksgiving, you eat that meal, you know it's coming. Some people like love that they get to do that on Thanksgiving. So like, would you rather just on Thanksgiving Day get to eat the traditional Thanksgiving meal that everyone looks forward to all year?
Or like Chick-fil-A.
Or you can pick whatever you want.
I'd like to talk about the fact that anyone out there listening that does love the Thanksgiving meal, plot twist, just make it at another time of the year.
Yeah, but you can have it on
Why
Thanksgiving.
Do you have to wait until Thanksgiving?
Because that's part of the nostalgia.
I love the Thanksgiving meal.
So you're going to go with Thanksgiving meal?
Yes.
I think I am going to definitely go with Thanksgiving meal, and I'm going to add in there that spiked cider it actually is the only time you can drink spiked
Christmas
cider like that. And Christmas.
Yeah.
Josh is going to go different. I can tell you. He's going to pivot.
I wrote this question because I'm debating. We're going on to Arizona to see my in-laws on Thanksgiving. I'm debating asking if maybe we shouldn't make the traditional Thanksgiving meal because my kids don't really eat it.
Drama.
My wife is vegan, so she doesn't really eat it. So then I'm eating turkey. And plot twist, I think turkey's super overrated.
Oh, I love turkey.
Oh man,
very
mixed
lean.
with the mashed
dry.
potatoes.
Very lean.
Well, it's dry if you cook it.
Why
poorly.
not? Why not go buy a filet mignon for Thanksgiving?
Why
instead?
not the dark meat, Josh? The dark meat's not dry at all.
It's better, but man, I don't know.
And the leftovers.
I know, but like,
Turkey
why not, would you rather not
sandwiches?
have a steak on Thanksgiving?
No, I'd
Actually
rather have
not.
turkey.
Yeah, it's surprising. I also wouldn't really love a steak for lunch.
Oh man, steak is the best.
Well, it's one of those controversial holidays too. Like, when do you eat? I know mom and dad are always like, we're going to do 10 a.m. We're going to do 3:30. I'm like, that's not a meal. That's never a meal.
Thanksgiving always happens somewhere between when lunch should happen and when dinner should happen.
But sometimes it's in the
it's
morning.
never
Sometimes
at lunch.
breakfast.
It's always at about 2 p.m.
I cannot believe that you don't think you should eat the Thanksgiving meal. That's nuts.
All right.
Why not just eat the Thanksgiving meal today, Luke, and then I can have a steak on
Well,
Thanksgiving?
I don't like actively look forward to the Thanksgiving meal. I'm just like, oh, this is good food today. I'll eat this. This works.
Some good controversy.
So
Everybody,
you would rather just wait, to be clear, you would rather have this good meal that you get to have versus anything that you want?
I can get anything I want whenever I want, but
Yeah,
most of
why-
the time someone's cooking this meal for me as well, which is
the same
that's
argument applies in any.
What if
day.
someone was cooking?
I can
you,
kind of get whatever I food when food.
What if
whenever
someone was
I
making
want
you
these
chicken
days.
parmesan for Thanksgiving?
I would just eat that on Friday
I would probably eat the chicken parm on Thanksgiving.
if they were making it.
Yeah.
Oh, so you just don't want to have.
Like if
to
I
cook.
was showing up to a thing and they were like, "Hey, we're not having Thanksgiving dinner this time. We're gonna have chicken parm," I wouldn't be like, "Let me go buy a turkey and cook it."
Got it. So
I'm just
you're
gonna have
just
the
more
chicken
like
parm.
you don't want to have to put the effort into
I would
cook
be
versus
appalled.
eating the same thing.
You would be.
Yeah, it's terrible. It's
Tradition.
Thanksgiving.
Well, I'm happy we could round
All
out
right,
the
voters.
last Would You Rather week.
I want
rather
to
of the
know
week
though, the
all
listeners.
time.
They asked for this on a poll. Haley said, so I want to hear what you would rather do. on
No,
Thanksgiving.
we asked the listeners if they liked the Would You Rather of the week, and 5 of them said yes, and 3 of them said no.
That's
so
more
majority
yeses than
rules.
nos.
That's like a 625 batting average.
I'm just making up numbers. All right, let's get into what actually matters here. The Fed meeting, the last Fed meeting. So talk to us about kind of what happened there and what they said about it.
And just so we're clear, I will not be making up numbers on this podcast today. I will be giving actual numbers through the whole thing. Brotherly banter here. The Fed last meeting chose not to increase the overnight rates. This was effectively, by the time this podcast will be released, 2 to 3 weeks ago. This is a big deal. We've been kind of anticipating. Most people thought the overnight rate wasn't going to increase during this Fed meeting, but some people thought that they might by a quarter point. They've obviously been getting close to the top of where they believe the rate is going to go or where they've said the rate will go. But the Fed has continued to be really tight-lipped around, there's conservatism in every conversation. It's always like, well, we're not doing this, but maybe we'll do this. In this case, they said the economy's been more resilient than they anticipated, but they were cautiously optimistic about the future. Kind of said there's a number of risk factors. We're not sure what we're going to do. I think strategically they've continued to do this because their goal is to not overheat the economy, right? So things were so hot during COVID and so many things happened that they had to unwind that they're always going to walk this fine line between, people are so ready for the market to come back to more of a normal place where they can put their money out back into the economy. So I think they're continuing to tightrope this thing, but I'm not surprised that they went the route that they did with that.
Do we have any specific numbers on what they were looking at that said the economy is looking resilient? As far I think like the jobs
have been hot. The CPI still has been coming in. I mean, we said today, which we'll get into where it is now, but it was still in the 4s. I mean, for a long period of time this year, their goal is 2. So you're talking double the inflation that they wanted, specifically on like consumer items too, which has made, like just an average family's household budget is up several $100s this year versus last year, which is, it's very impactful. So they really don't want that to happen. But then you couple that with record credit card debt. There's a lot of just mixed signals going on. The jobs report came out a little bit better last time around, which led to a lot of this and a lot of the yields dropping. But and I think on Josh's point, the big thing that you'll see out of the Fed is they're never really going to say exactly what they're going to do, because if they did that, it would chart the path for the investors to just go crazy. So like if they said, we're done raising the rate, we're not doing it, we think we beat inflation, you would see the bonds just get bought like so fast that you could see some calamity within the markets, and they really don't want that, obviously, because it's just this super volatile movements up and down are not good. I will say this is the fastest they've raised the overnight rate as high as they have, from 0 to 5.5 within 10 months. I mean, that's wild. They don't even know what's going to happen, if I'm being honest. We've never done this before.
Yeah.
There's a horse in the hospital.
Yeah, right. I think similar to like if you think of the real estate market, they're never going, and similar to how we talk to our clients about the real estate market, right? You're never going to speak in certainties, because if we suddenly knew tomorrow, like interest rates are plummeting 1.5 points today, you create chaos, right? These wild swings are what we had during the cold COVID cycle. That's created back and forth chaos. The market's too hot. The market's nothing. The market's too hot, and it's just they need some level of consistency to kind of normalize for everyone. But because everyone's been sitting on the sidelines so long with their money, everyone's basically putting all their money in money market accounts for the last 2 years. Like the second that they say something, really with a lot of certainty, you're right. The investors are just going to go nuts. And so people are like really chomping at the bit to get out there. So the Fed is going to do whatever they can to kind of tamper that down, because they don't want to swing the pendulum again and create that chaotic reality for everybody.
And as basic as it gets, though, the Fed chose not to raise the overnight rate at the last meeting. So tell people what happened to the 30-year interest rates when they decided not to increase that.
Bonds got bought, rates went down. It's pretty simple, right? Like when in every single Fed tightening cycle, as they approach the point where the market thinks they're not raising the rates anymore, the bonds are going to get bought. They're going to go down. That's going to lead to the MBS market cooking up, having more liquidity, and the rates moving downward. So 8% was kind of where we were at, like 8.03, I want to say, before that meeting. They got all the way down to like 7.31 on a national average. Mortgage News Daily, everybody. So they moved fairly rapidly downward.
And part of that, though, was also the spread between that. We talk about that spread quite a bit.
Yeah, and we should start to see some compression, hopefully. I mean, between 2013 and 2019, that spread was 160 basis points, so 1.6% above the 10-year yield. If we were operating in the same market right now, the rates would be in the low 6s. But as you see, they're not. So that spread right now is around 280 to 290. But we did see that spread.
It was like 310, wasn't it?
Yeah, it was a lot higher. And the 210 yield curve inversion actually started to uncouple a little bit. I don't know where that's at this morning. It'd be interesting to look with the 10-year moving sharply down. But you started to see, when you see that yield curve, the 2-year was running about 1.1%, 110 basis points over the 10-year at the top. So it was really, really inverted. That would signal like we are going to have a recession. When it uncouples, most of the charts I looked at, as soon as it gets like right at 0, that's like mid-recession on the darkened out lines. So if you go on like the St. Louis Fed, you can find that, and they dark out the lines where the recession was. As soon as that number and the 2 and the 10 are even, that would be like the middle of the recession. And And in a normal bull market, the 2-year would be a lot lower. You'd get less return on a 2-year than a 10, because that means the long-term outlook is a little bit better.
And I know we call this the Nerdy Agent Podcast, so you come here expecting us to really go deep on some of these more complex topics. But to kind of simplify what you're saying, because I know that was a lot to kind of process, in general, the Fed right now, as they increase the overnight rate, that tends to push down, you've probably heard this from us a number of times, to the 10-year Treasury and the 2-year Treasury. They continue to move. And as those things move, mortgage rates tend to follow, specifically that 10-year Treasury yield. So when the Fed decided, hey, we are not going to be increasing the overnight rate, that created some positivity within the bond market, that we would see bond yields that people bought them because of this decision, that caused that 10-year to fall, and then the mortgage rates kind of followed suit. The concept that Luke was talking about was the difference between the 10-year and the 30-year mortgage rate. The gap there is bigger than it's been historically. So if we see more consistency within the market, if we see a tightening, or just the Fed saying, hey, we're going to pause now, that should drop theoretically to a smaller number. So we should see mortgage rates would continue to fall, even in the event that the Fed continues to say we're not raising rates. So if the Fed does nothing and keeps the rate where it is, mortgage rates can still fall because they are not necessarily the same. They're actually quite different. So they're just more correlated in the way that they create adverse or different behaviors and responses to the other marketplace events.
Did you have another piece on that you were looking up, or is it for the next?
No,
okay.
We just have one of our numbers right here.
So the next two things that I want to talk about were the PPI and the CPI, because they both came out last week, I think. The PPI.
CPI was this morning.
CPI was today, but last week was the PPI, or a couple weeks ago.
Last week.
So just to move on, because these are kind of the two biggest indexes that they look at, the Fed does, to affect kind of what they're going to do. So tell us what the PPI looked like.
They also look at the consumer spending
weeks.
reports, which we don't have on here. Mm-hmm. Importantly, I believe that the last report that came out on that was below expectations. Mostly, again, that I talked about, like consumer credit card debt is at an all-time high in the trillions, and that consumer spending report actually came in low. But again, there's
been
all
resilient too. Like even as they've been doing this, people keep spending money, and they're trying to figure out how to stop people from spending money.
It is interesting, and it's it all works together, but to my earlier point, there's a lot of mixed signals, right? Because the PPI came out and that was above expectations. That's a leading indicator.
What is the PPI being above expectations mean?
The producer price index is, so the CPI is the consumer price index. So that's what we're paying for goods and services. The PPI is what we're producing those goods for. So, assuming every business works at the same margin all of the time from a profit perspective, you would see the PPI bleed into the CPI. Mm-hmm. Obviously, it's a lot more complex than that.
So when the PPI comes in above expectations, it means that the costs of the goods went higher than they expected them to go.
And so then you would say, well, how long does the PPI take to impact the CPI? And you would probably see the CPI kind of do the same thing at that time period. But, even though we saw the PPI come in hot, I think Luke said last week, the CPI actually came in lower than expected. So there's a lot of complexities within the market, and a lot of numbers they're looking at. And if all of them were trending the exact same direction, the market would know exactly what to do and it would move in that direction, but it doesn't really know right now.
And in a weird way, like all of the geopolitical uncertainty and how that's going to respond and what that creates in terms of economic risk, there's a lot of different things that are just up in the air. So the Fed is smart to be saying, we're not really sure about the future. Like we say with real estate, right? We tell people all this time. I got upset last week because I felt like a lot of real estate agents were basically saying, here's what's going to happen in the future, when you don't know what's going to happen in the future. And the Fed is smart to say, we are seeing this, so right now we think this is the best thing, but we don't know where 6 months from now things are going to be. We'd be silly if we said we know exactly where they're going to be in 6 months.
I had a post on Facebook I commented on, I think it was the Minnesota Real Estate Network, where a guy posted, like, what do you think rates are going to be by Q4 next year? My opinion's in the comments. And I just posted like a long thing about all the factors that are involved in making these kinds of predictions. And he said, well, then what's your opinion? He responded to. And I said,
is there a world war going on?
Well, I said, like, if this happens, if this continues to be this way, then this probably will happen. But there's a lot of ifs there that I don't control. So I'm not going to make a prediction, because if any of my ifs don't come true, my opinion's going to be different.
Yep.
And I don't control or know if those ifs are going to happen. Right. And so that's really, really important when you're talking to people. The certainties, like Josh said, is like, that's where people get themselves in trouble when they say, well, the rates are going to be 5 and it's going to be crazy. And it's like, well, we need this, and this to happen first for that to actually occur. So,
and even if that does happen, who knows what's going to happen to the buyer pool between now and then? Who
But
knows what's going to happen to the supply between now and then? There's other things that can happen.
Exactly. But just knowing these numbers coupled with the numbers we follow from real estate, specifically in our Twin Cities market, can help you to better advise your clients in real time, not in 1 year's time, but in real time. I can say, here's what we're seeing. Here's what these numbers are doing. Here's kind of our expectation for the next amount of time if this continues to go this way. And then you can basically arbitrage for your clients and save them or make them a ton of money, which is super cool. So cheers to and props to everybody who's listening to the podcast, because this is the kind of stuff that you need to properly advise your clients in real time on what's happening right now to really get them into a positive outcome in a favorable situation.
Yeah.
He started touching on it. So tell us, what are we thinking like in the future? We talked about PPI and CPI. We talked about what the Fed did last time.
Yep.
What do we think the future is going to bring? They're also going to be meeting in December.
Yep.
I think the 12th or the 13th it said on there.
10% chance of a hike in December,
I think the CPI coming in low. I mean, we'll have more CPI data before the next Fed meeting. But if we continue to see positive momentum in the CPI, I think that's going to lead to the more likelihood of it being another pause or another delay. I think the Fed is still going to trend very, very cautiously because there are things even outside of their control globally that they just can't make predictions with a lot of certainty through. So my hunch is I would guess there's a high probability at this point based on what I'm seeing. I think the CPI with the data we saw today will probably continue to be positive. AJ and I were talking before the podcast that we think, the Fed may have actually pushed harder than they needed to with the data we're seeing now. And so if we see the CPI continue to come in lower than expectations and get closer to that 2% range, we could be at a point where that landing has happened already, and we're just going to see in the future the impact of the things that have already happened.
The thing to look out for is if it does get close to 2 and they're at the same number, when do they start considering a cut? Because they have to always be out in front of what's happening. So if at the current rate, if they achieve 2% CPI and they haven't cut yet, they're probably too late. Because what's going to happen is it's just going to keep going down. If it's just trending downward all the time, and they haven't cut yet at the time it hits 2, then they've gone too hard. And they're going to have to figure out how to scramble and get it back to 2.
But behaviorally, the cut is going to be a huge signal to the marketplace, and so they're going to be very cautious about making that decision.
Yeah.
So even if they've overshot it and CPI starts coming in at 1, I still think they'll be very patient in cutting unless there's a lot of pain in the marketplace.
Well, but if you look in history, the only time this ever happened was in the 80s, and we had no inflation. We had way too much, and then we had stagflation, which is a bad economy and just not a good situation. So I think they're just trying to kind of use all their metrics to land it at 2 if they can.
As close to it.
Keep it at 2 for, the near future and beyond. So
Yep.
And they're talking about the inflation rates in the market.
The CPI, essentially.
The CPI inflation rate, their target is always 2%. And so they want to get it to 2. Currently, it's above 2.
3.2.
3.2 on the CPI.
3.3
and they're also
was the
saying
estimate.
that if you didn't catch that, they're also saying that if it goes too fast below 2%, it can also be considered a bad thing. So if it all of a sudden went from 3 to 1 in a 2-month span, that would be a signal that they need to do something to try and get it back up to 2. Which is super counterintuitive because for the last 2 years, we've been talking about how they need to get inflation down just so people are having the concept they understand that.
There's goods and services, and then there's businesses, right? And so when we talk about jobs, when we talk about CPI or PPI, in a capitalist market, it all have to work together. And 2% is kind of the number where they determined we're at a good number of employment. People are being paid a fair wage, and goods and services aren't costing them an arm and a leg when they get done with work and go to buy groceries. So they're trying to get to that. But if it goes too far under that, now you have a market where prices are not increasing fast enough. The businesses are struggling. They're going to lay people off, and now you have unemployment running up way too high. So they're trying to thread the needle and get to that number without making it, come down too fast. But also they don't want it to go up. So it's just this really difficult balancing act.
Yep.
How that affects you as an agent in the real estate market is it's going to affect the 30-year interest rate as that goes down.
Well,
that rate
and
typically goes down.
employment.
And employment, which is going to affect your clients. What do we think the projections into 2024? Because people do care as much as we don't know where they're going to be. The 30-year fixed rate. Fannie Mae, I believe, came out and said by Q4 theirs was 6.5. I think the Mortgage Bankers Association was 6. But note that their prediction has always been
More
a half
aggressive.
point to a 1% point lower than what it ended up being when their prediction came out. So I think Fannie Mae, if everything stays going where it is and where we think things are going, that's about where you're thinking it's going to get to.
Yeah, I mean, it could be a combination of a few things, right? There's two things like we talked about that impact it. We could see the yields drop. If the Fed says we're done, the yields will drop. And even at the same margin we're at right now, the rates are going to be 7 or under. If you start to see some margin compression and some more buying in that marketplace, then you're going to see that spread between the 10 and the 30 drop too. So it could be one of those two things, but so much of it depends on what the Fed decides to do. If they keep unwinding their MBS positions, then that spread gets bigger and bigger because there's so many sellers and not enough buyers. So you've got to have a situation where that both of those happen, right?
Yeah.
For the rates to move meaningfully down.
I would say, yeah, there's more signals, especially with the good CPI news today, that we will see rates continue to go down, right? That maybe 8 was closer to the top than what we thought, but that's barring future CPI news that may be negative. We don't know. So I would say I'd be less surprised now than I would be 2 weeks ago to say rates will creep under 7 into 2024. I don't think rates will creep under 6.
I was just about to say the one thing, please don't tell your people that they're going to get to the 5s because you're just thinking that because it's going to be best for you. I don't think that's where that's going to be.
Yeah.
And note, I don't personally believe that rates in the 5s would be good for the real estate economy in 2024.
Do you think rates will,
I think it will
do you
be
think
bad.
you will die before rates have a 3 again?
No.
You think you'll see it again?
I'm 28.
I don't know. I think I'll
60
die.
years. I don't
There's
think I
enough
will.
time that it's very, very hard to make that call.
See, if
you
this
need
happens,
the
and
overnight.
then
You need the overnight rate to be at 0, basically.
at some point, it
Yeah,
probably
yeah.
will.
So I had this weird thought as we were going through this, and it's very nerdy. So I'll just leave you with that. I love sports as you guys do, and I love playing fantasy sports as maybe you guys do, but maybe not to the same level that I do.
Not quite.
What I've learned in my time playing that is the difference between the best players and the people who are just average at it is the fringes, right? Because you can only predict with statistical certainty about half of the things that will happen in terms of statistics in fantasy sports, specifically baseball. The ability to win consistently, and people do this, is their ability to look at it and say, I think maybe this will happen with some statistical certainty beyond that 50% range, right? So kind of what we're talking about today is like, we know with maybe some small level of certainty where we think things are going to go, and other people do too. They're hearing the same things. But the ability to understand something a little bit better than everybody else to try to win on the fringes is how you have more success than everybody else. Even though you're going to be wrong a lot, right? Like we've been wrong a lot over the last 2 to 3 years, but I think we've had more success than other people have because we know enough of it beyond what just the standard base level is to make educated guesses about where we think things are going to go and then react with our business appropriately to those things. So even though we're not operating with any real certainty to what we're talking about here, understanding these things and having a sense of where you think it's going to go will help you win on those fringes and is going to be the big difference maker between future success and not having success. And understanding how to talk to your clients about this, for example, is another one that we've put here. So I don't know. That's my like, not
Love
to
it.
talk it back to baseball, but
That's
yeah.
a great,
brilliant.
That's a great finish, and that's all we have this week for the Nerdy Agent Podcast. And as always, remember, be better.